Welcome to the SWIB Podcast, where members of the Wisconsin retirement system can turn for timely information on the investments that help fund the state's pension system. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB.
And I'm Dusty Weiss, podcast producer.
For long-term institutional investors like SWIB, 2025 reinforced the importance of maintaining a diversified portfolio, managing risk carefully, and staying disciplined through market cycles. Rather than reacting to short-term headlines, the focus remained on fundamentals, valuation, and the long-term objectives of the Wisconsin retirement system. In this episode of the SWIB Podcast, we welcome back SWIB Executive Director and Chief Investment Officer Edwin Denson. We'll look back at how global financial markets performed in 2025, a year shaped by easing inflation pressures, shifting interest rate expectations, and continued uncertainty across economies and geopolitics. Looking ahead to 2026, we'll discuss the themes SWIB is watching closely, from the trajectory of economic growth and monetary policy to how public and private markets may respond to evolving conditions. We'll also talk to Edwin about where opportunities may emerge, how risks are being assessed, and how SWIB positions portfolios to remain resilient in a range of possible outcomes. Edwin will share perspectives on how SWIB approaches uncertainty, balances near-term market dynamics with long-term responsibilities, and continues to invest with a focus on meeting the retirement promises made to Wisconsin's public employees and retirees.
The SWIB Podcast is a regular opportunity for you to learn more about the people and funds that comprise the Wisconsin retirement system. Please make sure you subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members, and leave a review on Apple Podcasts so it's easier for other members to find this show.
Edwin, Happy New Year and welcome back to the SWIB Podcast.
Well, thanks a lot for having me, and Happy New Year to you as well and to all of our listeners.
So let's get our discussion started today, Edwin, by looking back at the past year. I think you have some good news to share with WRS participants. Can you give us a recap of where the trust funds finished in 2025?
Well, absolutely, Chris, and it is good news indeed. For 2025, the Core Trust Fund, the larger of the two WRS trust funds with more than $150 billion in assets, returned nearly 14.5%. And that left our 5-year annualized return at close to 7.1% per year. And those numbers are net of all of our costs. These both compare very favorably with the 6.8% return that is sufficient to maintain the stability of the Wisconsin retirement system, according to the actuaries. On the other side, the Variable Trust Fund, which is an optional stock-only fund with more than $12 billion in assets, returned a tad over 22% for 2025, leaving its 5-year annualized return at about 11.8%. And again, that's net of all costs.
So how will those returns impact annuity adjustments for retirees and contribution rates for employers and active employees?
Well, since that 7.1% 5-year CTF return compares so favorably with the 6.8% actuarial hurdle and the 5% hurdle that triggers annuity adjustments, a modest upward annuity adjustment of between 2.1 and 2.5% is expected. Any change in the contribution rate should be small. The Wisconsin Department of Employee Trust Funds will release projected annuity adjustment ranges for both the core and variable funds in the coming weeks, with final adjustments to be announced in March of this year. Updated contribution rates influencing public employers and employees for 2026 will be determined in June.
So, Edwin, looking at the market more broadly, this was a good year for stocks, in large part thanks to these red-hot tech stocks that we keep hearing about. What are your thoughts about how the stock market performed in 25, and is it sustainable headed into 2026?
Well, the public stock market had a very good year indeed. If we look at stocks around the world, so that's including emerging markets and including small and mid-capitalization companies in addition to large cap, the broad market returned almost 23% for the year. The interesting dynamic in 2025 was that although the broad U.S. market did very well, up about 17%, markets outside of the U.S. did even better, returning almost 33%. So that is almost twice the performance of the U.S. This is the first year in quite a while where the market outside the U.S. not only outperformed the U.S., but by such a wide margin. And that worked to our benefit as we have exposure to this wider swath of global stocks in our investment policy portfolio. As for the sustainability of the strong showing in 2025, it's always a difficult question, and particularly when market performance is driven by a relatively narrow subset of companies like it was this year. In this case, technology stocks, as you referenced, and in particular, anything to do with the burgeoning artificial intelligence revolution really took off. The challenge is that although the AI revolution is real and will improve the efficiency and effectiveness of the way that we do many things, and actually completely change how things are done in some cases, it is next to impossible to really know what companies will be the ultimate winners and losers 10 to 20 years from now. This feels somewhat like the market experience during the internet revolution of the late 1990s. Many companies then were priced as if they were going to be the big winners, but in the event that turned out to be true for only a small subset of them. The difference this time around is that many of the high-flying market leaders associated with AI are businesses that are well-established and have well-established cash flows, positive operating margins, and meaningful profitability. And that wasn't the case in the tech boom in the 1990s. That's all to say there's reason to be cautiously optimistic that the sorting out of AI winners and losers over time will be less disruptive to the market as it plays out relative to the post-2000 tech unwind, which lasted for well over 2 years and brought the entire market down with it.
Of course, the core fund, Edwin, the larger of the two Wisconsin Retirement System trust funds, is a fully diversified fund. Can you give us a little insight into how other asset classes were performing in 2025? Anything surprise you?
Well, of course, I can give you the rundown here of, broadly speaking, it was a good year for almost every asset class and market. Public fixed income had solid returns, ranging from mid-single digits for U.S. Treasury bonds, all the way up to almost 20% for local currency emerging market debt, high-yield bonds, leveraged loans, investment-grade corporate debt, and mortgage-backed securities filled out the range. On the private market side, credit and debt provided returns in the 8% range, private equity returned close to 10%, and venture capital was close to 19%. Blended all together on the private side, the private equity, credit, and debt and venture capital returned about 11% for the year. So overall, solid support from the private side, except for real estate, which had a challenging year, providing around a 3% return.
Given the performance of those different asset classes, do you feel good about the asset allocation targets that are set for 2026? I know there was a small tweak in those targets that the board approved last December. How do you feel about where the core trust fund is positioned heading into this year?
Well, I feel good about how we're positioned going into this year. In terms of the asset allocation, the small change we did make was to reduce our exposure to public equity by a couple of percent. And because all of the other asset classes seem to be fully priced, we decided that the best thing to do from a prudent standpoint was to not redeploy that cash or that allocation. So again, we reduced our public equity exposure by 2%, did not add anywhere else, and so thereby reduced our policy leverage by a couple of percent from 12 down to 10%. And again, it just seemed like a prudent thing to do to take our total risk down a bit.
What is your thinking about the asset classes like private equity and real estate that didn't have a stellar year, but have long been a part of SWIB's overall diversified portfolio?
Yes, absolutely, Chris. So in your lead-in to your previous question, I think it was Dusty, you used the adjective diversified. And what that means is we have exposure to a wide range of asset classes and markets. The diversification reduces the degree to which any one asset class or market can hurt us, but it also means there will likely be laggards in any given year. It's rarely the case that all asset classes and markets have stellar years at the same time. And by the same token, it's rare for them to all do poorly at the same time. In the case of 2025, the laggard was real estate, but a positive return of 3% is really not all that troubling if that is the worst performer in a given year. I'd say that with private equity, the return was just fine in terms of the absolute number. It was near 10%, which sits above our long-run expectation for that asset class. However, it feels a little soft because of how well the public equity market performed. So making that comparison of private equity, again, a return of about 10% to public equity, which returned over 20%, is what makes the private equity return feel, again, a little light. But nonetheless, I'll talk about private equity and a little bit about real estate. Okay, so U.S. private equity started off slowly in 2025 as a result of post-election uncertainty, unpredictable tariff announcements, and market volatility, which caused deal makers to take a pause on activity during the second quarter out of an abundance of caution. That pause was short-lived, and deal activity hit full stride in the third quarter and continued through the rest of the year. Deal value was actually over $1 trillion in 2025, a substantial increase over 2024. This is only the second time deal value has eclipsed that 1 trillion mark, with the first time being in 2021 when the level hit 1.3 trillion. And just to remind folks, deals are purchases of companies by private equity firms, and deal activity is a rough proxy for the perceived overall opportunity to invest in private companies. So by this measure, the amount of opportunity to invest in private equity was the highest that we've seen since 2021. So that's on the investing side, putting your money to work. Now I'll talk about exits, which simply put are how we get our money back from private equity investments. This can happen a few ways. A company can go public via an initial public offering, where shares of the now public company are received and then are sold. Secondly, a company can be bought by another corporation. That's mergers and acquisition activity. Thirdly, a company can be sold to another private equity firm, and this is called a sponsor-to-sponsor transaction in the business. And then finally, we can actually sell our stakes in private equity funds on the secondary market. Now, in terms of exit activity in 2025 overall in the marketplace, it actually saw a bigger increase than we saw in terms of deal activity, with the total exit value at about $730 billion. The IPO market had its most active year since 2021. Exits to corporates through M&A activity were also stronger than they were in 2024, as was sponsor activity. That's all to say that the opportunity to get money back for previous investments via these three channels was stronger in 2025 than was expected. The final avenue I'll mention was selling into the secondary market. This has historically been a relatively unattractive way to get money back, as the discount which you have to sell at is very unattractive. However, with the rise of retail demand in the marketplace, we took advantage by selling over $1 billion worth of stakes in funds that we had into the secondary market at a very small discount, with the intent to redeploy those dollars in an overall upgrade of the private equity portfolio. Now, going back to the comments that I made about the opportunity to invest and also the opportunity to get money back, for 2025, we actually ended up receiving more cash back than we deployed in our private equity program. And again, that's a change over the environment that we've seen over the past 5 years. The outlook for 2026 for private equity is expected that we will get increased activity across all markets, and with the typical caveat that we do continue to have some headwinds such as inflation, economic stress, and geopolitical turmoil, and those are expected to carry over and echo on into 2026. So again, the final thing I'll say about private equity is that it performed above long-run expectations and actually delivered a positive net cash flow for us in 2025. Turning to real estate, where the return was a disappointing 3%, but again, not very troubling. 2025 was a muted year in the commercial real estate markets in general, and that reflected the start of a slow recovery from the impact of higher interest rates. So we're still seeing the echoes of the large increase in interest rates across the maturity spectrum that started in 2022 when the Fed raised interest rates significantly. The Federal Reserve did not resume cutting rates this year until September, and there was a fair amount of volatility in long-term rates, and both of which kept borrowing costs elevated for most of the year. Operating performance and valuations were also impacted by large amounts of new supply in certain segments of the market, including industrial buildings in places like Southern California and the Inland Empire, apartments in the Sunbelt cities like Austin, Phoenix, and in general, life science office buildings. Shifts of behavior during the pandemic led to spikes in demand in these sectors. Unfortunately, the supply is coming online now at a point when demand appears to be reverting back to more normalized levels, meaning pre-pandemic levels. And it's going to take some time to absorb that supply into the marketplace. The introduction of uncertainty around new tariff policies also created some headwinds in 2025, particularly for industrial real estate. And while things appear to be stabilizing, there was a notable slowdown in leasing and transaction activity as market participants digested the potential impact of the changes. The short of it is that hangovers from the pandemic and the shift to a higher interest rate environment, along with some new headwinds in 2025, restrained the overall market. 2026 is shaping up to be a better year for commercial real estate, but it likely won't be until 2027 or 2028 that we see a more meaningful recovery. The headwinds experienced in 2025 are still with us, and any meaningful slowdown in job growth or consumer spending will negatively impact the market. On the flip side, the real estate financing markets are open and in good health, and there's a lot of options for borrowers. We're moving past the peak of the supply wave, and there's very little new supply behind it as construction and financing costs have moved many developers to the sidelines. And even in a sector like traditional office buildings, which was materially negatively impacted by the pandemic, we're seeing evidence of a recovery and renewed investor interest. Just as a reminder, real estate is a cyclical asset class, and while the past few years have been challenging, the setup going forward appears to be increasingly positive.
So, Edwin, certainly a lot of information to digest there. And certainly, I think folks can look at both the performance of the Wisconsin retirement system over the past year and the broader markets in general and feel pretty okay about where things are at, even good in some cases. But I have to ask, having done this show for more than 5 years now, one phrase that we heard over and over again for a couple of years there was the notion of having a soft landing, right? And the Fed setting monetary policy that would allow us to essentially bring down inflation without crashing the economy. Is it too soon to look at the state of the markets right now and say they did it? They nailed the soft landing.
Well, my perspective on this is that going into 2022, when we knew that the Fed was going to be aggressively increasing interest rates, the expectation that I had was that there would be much more market disruption from that than we ended up seeing. Now, of course, we did have a challenging year for capital markets in general in 2022, but not a complete disaster. And then we recovered very nicely in the subsequent years, and we did not end up seeing a recession. So it was actually quite remarkable that the Federal Reserve was able to raise interest rates that much that quickly without generating a major recession. Now, that said, I think it's a little soon to say that they have really succeeded in their efforts vis-a-vis the dual mandate because inflation still remains troublingly above the target of 2%. And with the Fed now easing interest rates, it's just really not clear that 2% really actually is the target at this point.
So, Edwin, I want to go back to the asset allocation discussion just for a second. Given where the markets ended the year, it's easy to forget how quickly and steeply markets dropped in early April during the initial tariff announcements. But SWIB's investment staff managed to stay calm right out the storm, and that discipline really paid off for WRS participants. One of the reasons for SWIB's success, I think, in 2025 is the investment strategy that's been put in place to help weather market volatility. That strategy starts with asset allocation. Can you talk a little bit about that process of coming up with the right mix for the core trust fund? And how do you stay the course when things are changing so rapidly throughout the year with that asset allocation?
So, a little bit on the process. We have long-run expectations for the risks and returns for each of the markets and asset classes, and also their correlations with each other. And what we do is every other year, we call it an on year, we engage with the actuarial consultant to essentially run a bunch of very long run simulations with different asset class combinations to really understand how those combinations would be expected to impact the overall stability of the WRS, which again is what our main goal is. And so we look at a wide range of potential asset allocations from ones that are not very risky to those that are more risky and identify what we call the Goldilocks zone, where we have a nice balance of risks between taking enough risk to be able to meet the long-term liability, but not taking so much risk that we cause a lot of variability in benefit levels. So there's always a trade-off there. Now, in terms of how we weather the storms, our asset allocation is designed to stand us in good stead in just about any environment. And what that does is it allows us to not have to try to react and second guess things in real time. And I think the April of 2025 experience is really a good object lesson in that, where many folks reacted in terms of changing their postures or their strategies based on the first announcements of tariffs, only to be caught off foot when those tariffs were delayed. So the whipsaw in the market that was caused by whipsaw in policy really caught some people out as they were trying to, I think, react too quickly to what they thought was happening. So again, having a well-diversified asset allocation that we believe will stand us in good stead in most environments is really beneficial, and very much of the mind that slow and steady wins the race.
And another key to SWIB's investment strategy is active management of the portfolio. You must be happy with the work SWIB staff put in this year to generate strong returns and really keep the WRS well positioned for the future.
Absolutely, Chris. SWIB delivered a return above benchmark, also known as active return, of 0.76% or 76 basis points for 2025. And over the last 5 years has delivered 0.65% a year or 65 basis points a year. These compare to an expected average of just above 0.5% or 50 basis points. That outturn that we've had is the result of the hard work that our investment staff undertakes in making investment decisions, whether it's selecting securities in our internally managed portfolios or selecting external managers to partner with and trust to deliver for us. It's hard to beat the market, but we deliver significant value in our efforts when we can meet or exceed our expectations. Now, numbers like 0.76% for 2025 and 0.65% per year for 5 years may sound small, but in dollars, that translates to $875 million in value added for 2025 and $3.8 billion in total value added over the last 5 years. And again, these numbers are all net of all the costs associated with the investments we make and with running SWIB.
So at the end of 2025, we had a chat with SWIB head economist and asset and risk allocation chief investment officer Todd Mattina, and we talked about what direction the Federal Reserve may take with possible interest rate cuts. Certainly the upcoming change in who will chair the Federal Reserve is on everybody's radar, and some of the geopolitical issues that can have an impact on the financial markets. The reliability of the economic data coming from the federal government is another thing that folks have been keeping an eye on. What are some of the issues that you're going to be keeping an eye on here in 2026?
Well, nothing much different from what Todd outlined, the Fed, the economy, geopolitics. He and I are partners in determining the overall investment structure in the fund. So, of course, we talk a lot, and so we're going to share a lot of the same views in the end. But what I would add to the list that he had is the continued rise of retail in the private market space and how we adapt to that dynamic. The jury is still out on whether the push will prove fleeting or become a more sustained and permanent dynamic of the private marketplace. If it is more sustained, we'll likely engage in more portfolio upgrading akin to the large secondary sale that we engineered in 2025 and devise other stratagems to guard against a degradation of returns with all of that potential capital flowing into the market.
So at the end of January, the Federal Reserve held interest rates in their first meeting of 2026. Were you surprised by that?
I'm not surprised because there is always a tension that ebbs and flows through time where the folks on the Federal Reserve, the board, and the bank presidents that are on the FOMC that vote on interest rate policy, they know that their job is to set interest rate policy in the best interest of the dual mandate of full employment and low and stable inflation. However, they are human beings, and they also do not like the idea that folks would think that they are being influenced by the public and or even the fiscal authority. Again, this is all about Fed independence and the well-established and well-accepted notion around the world that central bank independence is critical for the effective implementation of effective monetary policy. So even in an environment where you might believe that the best thing for the dual mandate is to perhaps lower interest rates a little bit more, it's understandable that there may be some hesitation to do that in terms of the perception game.
So, Edwin, I want to pivot a little bit here as we wind down and talk about how, over the past several years, SWIB has modernized the systems and processes that support investing more than $150 billion in WRS trust funds. This multi-year effort has improved how SWIB manages data, evaluates investments, and oversees risk, helping ensure the organization remains efficient, transparent, and well-positioned for the future. Can you talk about the importance of this effort?
It serves us well to support our investment staff with the best investment platform that we can provide in order to help them succeed in an increasingly complex, sophisticated, and competitive investment environment. I often describe it as having to run just to keep in place and having to sprint to get ahead. Data and systems are an integral part of that support, and to have confidence in forging ahead into more complex and sophisticated investment strategies, we need the risk systems to help us monitor and oversee our investment activity. You need the people and the platform.
So, Edwin, as we wrap up our discussion, what do you want members of the WRS to remember as we start this journey through 2026?
I think the key thing I'd like to communicate is that we are in it for the long run. Slow and steady wins the race. The Wisconsin retirement system is in a great position funding-wise, so we can run an overall investment strategy that appears perhaps a bit sleepy in terms of returns relative to some other pension funds, but we don't have to reach for return to keep the system stable. That is the slow part of the slow and steady. The steady part is that we have a well-diversified asset allocation that we believe will stand us in good stead in most environments. Hence, when we do make changes to the asset allocation, they tend to be relatively minor and driven by the medium to long-term outlook. That slow and steady approach, which the design of the retirement system affords us, leads us to our goal of stability, defined by steady and hence predictable contribution rates for employees and employers for the active participants, and on the retiree side, steady and modest upward adjustments to benefits.
Edwin, thanks for taking some time to look back at 2025 and forward to 2026. And to discuss some of the innovative ways SWIB is working to remain an investment management leader. It was great to have you back on the podcast. Thank you again for joining us.
Well, thank you for having me. And again, it's always great to be able to be on this platform and communicate to the wider world. Thank you.
And thank you to all our listeners for checking out this episode of the SWIB Podcast.
The SWIB Podcast is brought to you by the State of Wisconsin Investment Board with editing by Harrison Fonder and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com.
Thanks again for listening. I'm Chris Preisler.
And I'm Dusty Weiss.